Hello everybody. How's everybody doing today? Can you hear me okay in here? I just want to make sure I'm all hooked up and live and ready to go for day 7. Give me a little thumbs up if you can hear me all right. Aside from the little 15-second delay that we have. All right, I think we're good and ready to go. All right, everything should be hooked up, ready to go live here on day 7. As you can see by this wonderful slide I've created, I'm just kidding, not that fancy, but technical analysis today. What is it? So the last 6 days we've been talking about how to be a better trader, your psychology, the big picture, getting to know myself, getting to know Andrew here, and talking about the premium room for next week. And yeah, thanks everybody for the thumbs up. It's good to know that you're live. I have done a few videos before where the mic was shut off by mistake and I burnt through 20 minutes, so I don't want to do that again. It's all part of learning from your past errors and learning from other people's mistakes. So I'm going to hide this video here and we'll get rolling. So I just watched Andrew's talk this morning. I don't know if you've seen it, but it was really good. It was about fundamental analysis versus technical analysis. So here we are, finally getting into trading and actually learning how to do stuff on the charts. We're not talking about the mindset as much right now. We're not talking about, who we are and how you can get to know us. I did have a couple people in the chat, though, that said, well, who's this guy? So I'm going to give you 10 seconds. Most of you already know this, I think, but just so you know me a little bit better, I've been trading for about 10 years. I've done a whole bunch of stuff in the Forex market. I ran a bunch of websites. I helped to start a couple Forex brokers. I made videos for different professional websites on trading. This is my first experience with live streaming, though, and that's why we're still learning and having some fun along the way. I feel like, there are no mistakes in life. If something happens, you just got to learn from it. And I used to manage funds for people and did a lot of things. I mean, as far as managing money, creating expert advisor or automated trading robots, mentoring people one-on-one. I've sort of been around the block. I'm not out to say I'm the best there is or any kind of master or guru, because that's not the way it is. We're still learning. I mean, you look at Andrew, him and I are fairly close in age. He's got me beat by just a little bit, but he has way more experience than me because I was busy going to college and I have a few college degrees, biology, chemistry, minor psychology, and a doctorate in optometry. So I'm actually an eye doctor by trade, and I still see patients part-time. I really like my job. I mean, I went full-time for a while, and then I was doing so well working from home on different businesses and things that I didn't work at all for about a year and a half, almost 2 years. And one of my friends got me a clock that had, it was the round clock with the hands, not a new digital one. And it literally had the days on it, like Monday, Tuesday, Wednesday. Because when you're not working a job, you sort of lose track of what day it is. I mean, it didn't matter to me if it was Thursday or Sunday or whatever it is. The only thing that it helped me remember was that when I wanted to go out and play and have fun, go out and ride my dirt bike or go out in the woods or do things with my friends, they were all working their jobs. So I had to remember what day it was. And long story short, I sort of missed it. So I went back. I got my own little office here in a commercial location that I lease, and I have my own little eye doctor business. My specialty is in eye disease, diabetes, glaucoma, that type of thing. But I've been in the markets for so long now. For me, I mean, 10 years is a long time. I'm 41 years old, as you can see by my gray starting to come in here. So I've been around a lot, and I haven't been in the markets and then left for 3 years and then dabbled around. I mean, like I mentioned here, I think I signed up for this Forex Signals chat room 3.5 years ago. I think it was March of 2013, I think, something like that. So it was a while ago. And for those of you in the U.S., just so you know, obviously Thanksgiving is coming up on Thursday. The cool thing about this room is it pulls from so many different places in the world. I mean, there's a lot of people in this room that are from Australia, from Europe, from UK, London, U.S., Canada, and a lot of the other countries that it does go to. Of course, the language barrier is there. So. But here in the U.S., Thanksgiving is this week, and it's such a big holiday for our family. We get together, we make our turkey, everybody comes together, and it's just a great time. Everybody's off work, all the banks are closed. But I sort of forget that around the world, Thanksgiving isn't even a holiday, so it's sort of I have to remember that, hey, we still got to do business as usual. So I will be doing day 9 on Thursday morning, on Thanksgiving morning at 9 a.m. here, and going over the things and getting ready, because the markets don't stop for anybody, right? I mean, certain countries, certain banks might be closed, but that sucker just keeps on going. 5.5 days a week, 24 hours a day, ends on Friday afternoon, opens up Sunday night here in the U.S. anyway. So that's all that's to it. So let's get started with technical analysis. Andrew's talk, he talked a lot today about fundamental versus technical analysis. He talked a little bit about stochastics and MACD, RSI, ADR, and the list goes on. And that's really important, good stuff, because that's stuff I use. That's stuff you should at least know about. Like he said, he brought up a really good point. He knows about these things. He knows how to use them. He understands them. And to be honest, it doesn't take a lot of work. You can go on Google nowadays and look up MACD, and you can learn a little bit about what it is and get an idea. And then you test it out and you decide if it's for you or not. I really like just the naked candlestick charts myself. That's what I like to use. I do have a couple setups that I use for divergence, like you may have seen with the MACD and stochastics as filters. But really, I don't use a lot of it. Moving averages sometimes. But I'm going to get into a little bit about how the charts look. Now, the big disclaimer here is don't take this as gospel. This is just my opinion. And some of this stuff is very entry level. Some of it's a little bit more advanced. And everybody in this room can be, from different levels of experience. So bear with me on that. Here we go. So there's 3 main chart types used across the Forex markets. A lot of you know this. There's bar charts, there's line charts, candlestick charts, and there's a lot of others. I don't know the name. This would be a question for some of you guys. I mean, I've seen it many times, but I never used it. The little charts with the XO thing. I mean, I know that was pretty much the thing back in the day, but I've never used it. And there's all different types of charts. But really nowadays, when you look at videos, when you look at MetaTrader 4, MetaTrader 5, when you look at private independent charting companies like ProCharts and TradingView, you have bar charts, line charts, candlestick charts, excuse me, and maybe a few others. But that's really what we're going to look at here in just a moment. So I literally just took this screenshot last night. Not that it's a big deal to you, but this is the dollar yen on the 15-minute chart. And you can see the price is at 110.51, and now we're at 111.06. So this is the dollar yen bar chart. And the reason that bar charts are nice is, I wish I could point a little bit better at this here, but you have the bars, and then you have these little hash marks. I'm not able to zoom in too much, but the hash marks show the open on one side and the close on the other. And then the next bar starts, and you have the open and then the close. So you see this range of how the price moved within this 15-minute bar. And it's sort of clean, and you don't have to worry about colors like red and blue and green and gray and all that stuff. You just sort of have your bar, and it's really sort of clean. And for some of the patterns that we're going to talk about in a few minutes, sometimes bar charts are the best way. I like looking at them, and I think I can definitely appreciate the patterns more on bar charts than I can on candlesticks. But like most of you, I'm still a candlestick guy. So next is line charts. This really shows the price very smoothly, but it doesn't show the range for each time. So line charts, in my humble opinion, are probably the poorest one to use, and that's just my opinion. Some people might love them, and that's it. So don't hate on me for that. But I just don't like the line charts. You don't get an idea of how far price has moved inside each area, but it does let you see sort of the trend and the movement of the market a little bit more than some of the other ones. And this is the candlestick chart. They're all the same dollar yen 15-minute chart, and that's what I like to use. Whether you use blue up or green up or red down, whatever you do is up to you. But I would just try to stay fairly consistent with it so it becomes ingrained in your psyche and you see it as a repetitive color, and it works for you. So playing with the colors is fun and things, and it's good to do in the beginning. But once you get to be around for a while, you sort of want to keep things somewhat consistent. And you can see the candlesticks here. The whole body of the candle actually shows where the price range has moved within that candle, and the open is on one end and the close is on the other. And of course you can see the other candle starts right after where the other one left off. And these wicks are where prices moved and then was rejected. So if we're looking at a candlestick, let's say this longer one down here, I don't know how good you can see it. I do have pointers here I could use, but for this presentation, I'll just have you look somewhere in this area, and you can see the price came way far down here on the 15-minute. This bar started here, the blue one, it went down again, then it came back up, and it continued up, and then it went to the next bar. So the wick, we call them areas of price rejection. So something in the market, whether you believe in fundamentals or you believe in the big banks, whatever it is, something said that price is too low on this pair, and it pushed it up a little bit higher. So there we have the three main chart types: the lines, the bars, the lines, and the candlesticks. So support and resistance trading. There are a lot of traders that are making a lot of money these days, and that's all they do is support and resistance. And for those of you looking for the holy grail in Forex trading, sometimes it's disappointing to know that the easiest things are the most successful. You know, the thing about trading that I like from a psychology standpoint, from a doctor standpoint, is that it's a herding mentality, right? So what everybody uses, what the banks use, what I use, what Andrew uses, what the other streamers use, what the other brokers use, what most of you in the chat use, if we all use something similar, support and resistance, trend lines, that type of thing, it starts to become a self-fulfilling prophecy, right? And that's what we want you to be able to look at. So we're going to learn some of the basic stuff here quickly, and then we'll get into more advanced stuff in the near future. But support and resistance, I just want to give you a minute on this. This is the dollar yen, and this is a 30-minute time frame. And I apologize here. Let me shrink my head just a little bit here. There we go. All right. So you can see where I put in this arrow, and I put the arrows in because usually when I'm doing recorded videos, I'll zoom in and pan on things. But for this PowerPoint, I'm just going to show you this picture. Here you can see that price was rejected on the dollar yen. It rolled over, and that becomes a resistance level, and it was actually a double top here. And then when it comes up again, it just sort of explodes right through, comes up, gets exhausted. This becomes another resistance level. And now it comes back down. And if you look at this happens over and over. And you can see the price comes right down to this exact same level that we had over here. If we look left, that was the resistance. Now it becomes support. And the price continues all the way up, comes up to this resistance level, hesitates, breaks through, comes back down, goes up, and then it rolls right back almost to the pip or two of this area over here. So this resistance here became support over here in the new price range. So it's not always this easy, obviously. And if you only use this, you're going to go broke. But it's so repetitive. And that's why trading the majors is so good, because the majors have more of the people that are following this type of setup, in my opinion. We all know some of the exotic currencies can whip like crazy, but sometimes you can do really well with this support and resistance there as well. So support and resistance in a nutshell, the resistance level when we're going up becomes support later, and vice versa on the way down. So the key is to look for those levels. And if you do the system, sort of like Andrew uses, the trend continuation strategy on the dollar yen, if you're looking to buy this pair, you obviously don't want to buy at this blue arrow in the middle here at the high. You want to wait until it retraces a little bit. And if it doesn't retrace and you don't get in, well, you didn't lose any money. You know, Forex is so about capital preservation that it's just unbelievable. It's not about looking back and saying, darn it, I should have got in. You know, you shoulda, woulda, coulda all over yourself. You probably heard that line before. But you got to look back and use the clues that are to the left. So trend line trading, just to keep it really easy, this isn't a perfect trend line, but I use the same exact chart because I want to bring up a point here. So trend line trading means that you buy on an upward trend every time that price comes back down to the trend line, and you sell when it comes up to the resistance trend line going up. So what you do is you connect the candlesticks at the bottom. Usually I like to connect the wicks, but sometimes you get a wick or two that are outside, and you got to just do your best. This top one came out a little bit nicer here. Again, I didn't pick this one for a trend line example. I actually picked it for support and resistance. But you can see here on the left, the wicks are over here on the far left, and the top blue line on the left side comes all the way through, and the price really respects that. So you can project that right out to this high level. Because a lot of traders who are new will say, well, this high level up here, before you put the trend line on and you're looking at support and resistance, how in the world do you know where it's going to turn? Well, you don't. You use Fibonacci levels, you use the A to B equals B to C, you look at the farther left time frames on the hourly, the 4 hour, and you try to get an idea. But the trend line, what a great way. I mean, look at that. I mean, it's just a simple, what was that, 110.96 down to 110.76. You know, you got 20 pips right there on a 30-minute chart. Pretty straightforward. Hindsight in Forex is so dangerous, you know. if you think about hindsight, you're going to kick yourself in the butt 1,000 times and think, how could I be so crazy and foolish and such an idiot to miss this stuff? And then you look at hindsight and you think, man, I'm the best trader in the world. This was so classic. I did it perfectly. And then you do it next time and it doesn't work the same. So it can really be humbling to trade the Forex market. Using hindsight, I mean, if you're teaching a course, it's so easy because you pick out some good examples and you look like you're the best in the world. But in the real world, it's not that easy. So we're here to bring that reality to you and separate the sort of fluff from the filler, if you will. So here's the cool part about this graph that I pulled up last night when I was making this. If you look for the confluence of signals, you're going to have a much more successful time with your trading. So I haven't used any kind of indicators or oscillators here as far as stochastics or MACD or anything like that. I haven't looked at correlating pairs. I haven't looked at news events. I haven't assessed my risk and reward. But if I'm just looking at this chart, now, obviously, as I'm pointing to the screen here with my hand, obviously, in this area, if we're just saying we're in the middle of the chart here, I don't know if you can see my mouse, going to the right, let's just imagine that didn't happen yet. And we're trying to trade this in real time, right? What do? So we look at support and resistance levels. Then we can draw on a trend line. And right where these X's are flying in, we have confluence of signals, right? So we have support and resistance levels that also meet roughly where the trend line is. And those levels, those confluence of multiple signals, can really be sort of the easiest trading that you can do. So like Andrew mentioned, and I mentioned, and a lot of other people who've been trading a long time mentioned, you're not trying to win 100% of the time. Obviously you're trying, but it's not going to happen. If you can just be at 50% or a little bit more successful, and you have a 1-to-1, 2-to-1, 3-to-1 risk to reward, whatever it might be, 1.5 to 1, you're going to make money hand over fist trading the markets. So if you have good risk to reward, you only need to be right half the time, and you're gonna get rich trading. Really, I mean, disclaimer, but you get the idea. So sometimes the easiest ways to trade are the most successful. So look where those X's are. Even the first three, if you look at the first three X's here, let's imagine the other two didn't happen yet. Let's imagine that right in this area, if you can see my pointer, I know it's quite small, it didn't happen. You could project this trend line out here and say, well, I'm going to take a sell on this trend line. Now there's more to it than that. Or, hey, if price comes back down to this area that is resistance, now it broke through and this becomes support. If it goes through there, I'm going to buy. And if you extend this trend line on the bottom, it comes pretty close to that same area. So this is basically the concept of channel trading, really. Channel trading with support and resistance and trend lines. And you can become so successful just with a simple strategy. Just remember that it is not going to work forever. This thing's going to bust out up or down, and you have to be controlling your risk. So if you can get 2 or 3 or 4 trades or 5 or 6 trades with the same setup on the same pair, and then you have one loser at the end or 2 when it changes, if your risk to reward is great, you just got to rinse and repeat. Andrew said on his talk this morning, which is a huge point, he just wants to do the repetitive things over and over and over. And the more simple it is, the better. So let's look at pattern trading. How many of you know what this is down in the corner? Do any of you know? I'll give you a couple seconds here to chime in if you know what that is. I'm going to take a little drink of water here. Anybody know what that is? Well, I'm going to bring up this because I know we have a little delay here. So here, pattern trading, there's so many patterns out there. You can Google search for patterns and different ways to trade, but here are the big ones. Head and shoulders, double top, double bottom, triple top, triple bottom, wedges, triangles, flags and pennants, cup and handle, channels, and many more. Alpha says that is Mandelbrot fractal. So fractal is a good answer in my book. Very good. Yep, Mandelbrot. Very good. And fractals. And when we get into a little bit more advanced training on the Forex and just looking at charts in general, we'll talk more about fractals. But for fractals, we can get into fractals and Elliott wave theory and that type of stuff later. But it depends on what you want to use. But you're exactly right. So the black hole, a psych test. That's funny. Good guesses, though. But a fractal is correct. At least that's what I was intending it to be. I guess you could have put different things on it, but I thought it was a cool picture. So these are the more common patterns that we look for in the charts. head and shoulders, double, triple bottoms and tops, wedges, triangles, flags, pennants, cup and handles, channels, and more. And here's, I think, the take-home message before I show you some examples. The longer term time frame that these patterns are on, the more powerful and the more important they are. Okay? Doesn't mean you can't make money on a 1 minute chart with a head and shoulders, because sometimes it's so fast and so easy. But the longer term time frame you're on, when you see these patterns, the more important they are. And if you see it on a daily, a weekly, a monthly, it's a great time to go down to the shorter time frames to try to get a good entry on it. But you also have larger stops and that type of thing, of course. So the longer time frames are more important for the patterns because more people see them. There's more range of movement there. The short-term stuff, I do it. I love it. I love scalping, but it's a little more risky than the longer-term stuff. And that's why some of the best traders, the biggest money managers, only trade on longer-term time frames. And you hear that over and over and over. They sort of laugh at people that trade on the 1 minute, 5 minute, 15 minute because they think, oh my gosh, you're just gambling and stuff, but it's not that way. So take it for what it's worth. Here's an example that I put together on the dollar CAD. This is just showing a double top. I think it's pretty self-explanatory, but I wrote on the chart here, USD CAD, double top, 30-minute time frame. This is from November 18th. So this just happened. Actually, when I took this last night, it was actually a live chart. You could see the price at 1.34, and now we're at 1.3417. So the price moved slightly. So on a 30-minute time frame, usually I trade 1 hour and 15 minutes. I don't go into the 30 much. But I do use it on my phone because of the smaller screen, and I like to fit it in there. But you can see pretty easily, double top there. There's so much more you need to look at when you trade than just this, but sometimes this can be very easy. And if you look down and to the left down at the bottom here, you have basically a double bottom, right? And there's all sorts of patterns inside here. So this is just an example of a double top. So the price goes up to this area, comes down, and then it goes back up again, which is resistance, and it gets rejected. Usually in this area, it's a good time to look for a short order if other criteria are met first. So don't just trade based on this alone. You could do okay, you could get lucky, you could make some money, but you got to look at a lot of other things. This is a double top example. Head and shoulders. This is probably my favorite pattern because I feel like, and other people who've been in the markets a long time probably agree, just for me, head and shoulders seems to be the easiest pattern to see. And it seems to be the one that is the highest rate of success. And this was taken from, I think, chartpatterns.com. I think I give them credit here in a little bit. But the way that it works, and this works on any time frame, any currency pair, any stock, any kind of trading. This is just a common technical analysis pattern. So you have the left shoulder, the head, the right shoulder, and then the neckline. The neckline is where the shoulder between the head sort of bounced. And then you have a pullback and a target. So here's the way it works with the head and shoulder. The distance from the head top to the neckline equals the distance from the neckline to the target. And usually you want this pullback. Sometimes you don't get it. Some traders will short once this right shoulder is put in and it starts to get down to the neckline. They'll just sell it. But a true accurate head and shoulders technique would be to watch this neckline break and then the pullback back up to the neckline where it becomes support, and then the fall down to the target. So, you know, it's hard. When you're trading in real time, you see this setup, everything's matching, maybe your news is there, your risk to reward is calculated, the other currency pairs are correlated, you're ready to go, this thing's setting up, you just want to sell, you know, when the neckline starts to come, but you got to be patient, you know. Maybe there's not going to be a pullback and you're going to miss the whole thing. Maybe it's going to break through and then continue straight up and you're going to lose. So waiting for the pullback is the way to do it. But it's hard to do I mean, I'm a real trader, guys. I mean, I've traded for years and years and I've made mistakes on head and shoulders, but not waiting. The one thing to tell you, and I think it's self-explanatory, is that they usually don't look as pretty as this. I mean, this is a artist's rendition of a perfect head and shoulders pattern and pullback and target. But a lot of times you see the head will go up 2 times higher. The right shoulder doesn't go as high as the left shoulder, and you can use your imagination. The other thing to know if you don't is that these also work flipped on the bottom, the inverse head and shoulders pattern, and they work equally well. I still like the regular upright one. I just feel like more people see it that way. But this H is the distance from the head to the neckline, and you want to look at the support area here as it's coming down as the neckline to become resistance. and that same distance is what your target should be. Now you want to calculate in your spread, especially if you're on a smaller time frame, and make sure that you have your spread taken into consideration. I like to be a little bit cautious on these. Let's just use, for example, just to make it equal for everybody, because some people trade with 100 lots, some people trade with 0.001 lot. Let's say I put a 1 lot order on this pair to sell. Let's imagine that it's a euro US dollar. I will wait. If I do a good job, I will wait until it pulls back. I will sell my 1 lot order. And then when it gets somewhere in this bottom area, maybe it's somewhere in the ballpark, I'll take off half the order, and then I'll put a stop in and let the other half run and hope it gets there. Because sometimes they don't work perfectly, and you can have a really good trade setup, make good money, and it doesn't quite get to that target, and then you give it all back. So I like to lock in some profit, but you got to let it breathe a little. Here's another example of a head and shoulder just quickly drawn. You can see the left shoulder, the head, the right shoulder, and the neckline. See how the neckline on this bottom one comes up? That's why I put this example up here for you, because if you're new to this, the neckline doesn't mean it has to be straight across. It can be up, it can be angling down, but the key is down here, it broke the neckline, and then it went back up and became resistance, and then it continued, and that's where you're supposed to be looking to get short on this example. So I moved the screen over here. That's what these arrows are for, because I know I'm off center here a little bit, but I moved the screen over so my big old picture down here wouldn't get in the way. This is probably one of my favorite head and shoulder pictures, and I took this years ago, I think 4 years ago or something. This is the dollar Canadian, and what we have here is a head and shoulders within a head and shoulders, and it's sort of cool just to see. Don't mind the moving averages and things, but you can see this left shoulder, you got this head, then you got the right shoulder and price continuing downwards. And then you have the mini head and shoulder on the top. So you got two really good patterns going on within each other almost perfectly. And yeah, Robert FX says you can trade both the initial break and the pullback. And I totally agree. But the way they teach it, the way the teachers teach it, which doesn't mean anything to me, is to be safer, wait for the pullback. But I usually get in right away. I'm getting better at it because I've been burned a couple times, but hindsight's 20/20. So, but I totally agree with you. You can trade either one. But check this trade out. So again, I know I'm on this little YouTube screen, but in the middle head and shoulders here, you can see I drew a very faint red neckline from the bottom here onto the bottom, and we had the right shoulder come in. It came down. It went up and retested that neckline literally to the pip or two. And then it fell down. And if I were able to draw on this chart, which I'm not right now, you can see that this neckline break down to this area down here, I don't know how good you can see my mouse, is basically the same length as the neckline up to the top of the head. This is just a perfect head and shoulders trade. And then we have it bouncing back, making the second larger neckline, rolling up for the right shoulder. That right shoulder up here matched basically exactly to a pip or two of where the left shoulder was over here, and now it's coming back down again. So this is the kind of thing you can look for. If you can get this kind of setup, which isn't very easy to get head and shoulders within a head and shoulders that are so ideal like this, but if you can get something close, you have a really good chance of having a great trade. So I love head and shoulders patterns, and I think you should too, but it takes practice, and you'll learn obviously through back testing and trading your own live account that it's not all it's cracked up to be as far as easiness goes. Next is pattern trading the flag and the pennant. This is taken from chartpatterns.com. I want to make sure and give them credit because I was trying to find some good examples and draw things, and I thought, look, let's just take it from there. Look, maybe they'll get some traffic from this. I don't know. But totally fair here. Here's the flags at the top. There's a bull flag and bear flag. And then if you can read that there, it says pennants. And there's a bullish pennant and a bearish pennant. So the bull flag, the bear flag, the bullish pennant, and the bearish pennant, I love using these. They're so simple. If you can learn how to use your Fibonacci levels in here and get it to a good retracement, it can give you a great chance to go long if you're a bull or short if you're a bear without totally blowing out your account and having too much risk based on your reward. So let me give you an example of that. This is the Aussie dollar, AUD, USD, Australian dollar, US dollar, with a bullish flag or pennant. Now, this is the 1 hour time frame. And this is where we talk about the A to B equals B to C. Now, I'm getting a little bit ahead of myself because I get so into this stuff, you can probably tell. who's this crazy doctor guy, right? Who's getting into Forex trading and been doing this and gets all passionate about it. But I just love this stuff. If you have a passion like we talked about last week and you stick to it, you will succeed if you can take your time and be patient. And that's how I feel. So we're going to talk so much more about these patterns and setups and all these details in the future, but I'm just sort of whetting your appetite if you're new to it. If you know how to do it already, that's fine. It's something, maybe you'll get a few pointers out of it, but this is just a simple flag and pennant pattern on the Australian US dollar. And you can see we had the price bounce. This became support. This was resistance. You can draw the little pennant in there, the wedge. You can call it a wedge, but it's really not a flag or pennant. When we have the breakout, you can see this impulsive 1 hour bar. So this is a fair number of pips. This is the hourly chart. You measure the top of the flag or pennant to the bottom here, and you project that exact same measurement after the breakout. Some people do it from the bottom to the top. I like to go from the top to the top, and we can talk more about that later. But your goal is to get the same movement. A to B here equals B to C here. And you can see this is just a classic trade that worked out really well. So this is trading basically a breakout strategy on a flag and pennant in the Australian US dollar 1 hour time frame. Lastly, I'm just going to touch on moving averages because we are talking about technical analysis, and a lot of people use these. If you look at my charts in the past, because I've done so many videos over the years, but I use them sometimes, but not all the time. This is from one of the websites I used to run. This is my little system that I used. But here you see the 200 SMA, that's the green. The 50 SMA is the black, and the red is the 20 SMA. I listened to Andrew's talk just a short time ago. He likes to use the exponential moving average. And like he mentioned in his talk, exponential moving average, in a nutshell, now again, this is just my opinion, basically takes out any big whips. Like if there's a news release or if there's some kind of big whip in a candle or two, it'll factor that out and put more weight or more emphasis on the more recent candles, where the simple is just an average of 200 candles in the past, 50 candles in the past, 20 candles in the past, or whatever you put. I like to use simple. It sounds like he likes to use exponential. I think a lot of people use exponential as well, so it's up to you. But the 200 is really sort of known around the markets, at least from the ones I know, that's sort of the longer term thing. And when you're on the daily or the 4 hour, that sort of helps you determine the trend. If it's above the 200, it's an uptrend. If it's below, it's a downtrend, and vice versa. Trading the crosses, that's I think some of the biggest scams in the Forex market. Buy my system for $99, learn how to trade the moving average cross system, and we'll program an EA for you so everything's automatic. When it crosses, you buy or you sell and you're good to go. The hard part is, and I've been trying to tell people this for years, and it's so rudimentary and so simple once you do it for a while, but if you look at where the red and the black line cross up here, they cross up here and they say sell here and then get out when they recross here. But the candlestick, the price action is already down here by the time they cross because they're lagging indicators. So if you sell when they cross and you get out when they recross, you're basically at a loss or break even right here. And they say, oh, you made 60 pips. And you got to be careful. And that's why we're here to try to help you guys out, we don't want you to fall into all these scams and different things that are on the market. We want you just to learn it the old-fashioned way, learn it the way that works, learn it the way that looks at all the stuff that's out there and distill it down into your own trading idea and trading opinion. So how are we doing at time? Okay, we're already at a half hour, so I'm going to skip right through this. I just want to touch on that. There's so much more. Technical analysis is the way that most people trade entirely. So there are books and courses, and you could spend $1,000 learning this. But I just want to teach you the basic charts, the patterns that I like to use, and at least the basics of the moving averages here. And we're going to talk more about it in the future. But just to give you an overview. So I showed this yesterday. If you missed it, I just want to flash it real fast. These are some of my favorite pairs to trade. Euro dollar, Euro Aussie, Australian US dollar, Euro pound, dollar yen, pound yen, Euro yen, gold, silver, and my notorious dollar CAD. Every time I look at the dollar CAD, I get this emotional thing because I do so good with it, but yet sometimes I do so badly with it. So dollar CAD and me, that's sort of my nemesis, but I still look at it. I still like it. It's sort of the one that I love to hate, if you will. Last time I talked about this too, I had probably 10 people ask me to put this up today, so I'm just going to put it up real quickly. Before I get into any trade, I look at the trade idea and what I want to do. I analyze the market. That's all these 6 steps and more. Decide what to do, calculate the risk, and place the trade. So I know you just saw this yesterday if you watched, but it's so important. This is what I do personally. We check the news events first. Never trade without looking at news. You don't want to get surprised and blindsided. Check the pair bias. Are you in uptrend or downtrend? If you're in one or the other, you only buy or you only sell, and that's it. Top-down analysis. You look at the monthly, weekly, daily, 4-hour, and you go down. You don't want to be surprised. Check your correlating pairs. If you're trading the dollar yen, take a peek at the euro yen. Take a peek at the pound yen or Aussie yen. Make sure that you're picking something that's somewhat correlated. Pick the one that's best suited for what you're looking to get. And number 5, very important here, guys and girls, look left for clues. So you want to look to the left of where you are. Let it give you clues, support and resistance, look for highs, lows, that type of thing, so you're not caught off guard. And then number 6, you check your structure, like we just talked about. Support, resistance, pattern, trend lines, key levels, and then you place your trade. All right, I guess that's enough for me. We're looking at a little over a half hour. I thought it'd only be 10 minutes, but I get so into this stuff. I love it. So if you work with Andrew and I, if you get in the premium room, it's free. We start it next week. Look, we're still working out some kinks. We're still planning some things, but that's what makes it fun. I mean, your input's going to let us form what we really do and how it works. So we have all these good ideas, and we're putting some on the where the rubber meets the road. We got some cool things already there in the premium room, and we're already in there beta testing it. So it's sort of fun. Tomorrow, day 8. It's Wednesday here in the U.S. I know around the world it might already be Thursday, but 8:30 a.m. I'm going to be talking about fundamentals and how to keep a close eye on them and how to let them work in your favor, not break the bank, not get surprised. We'll talk a little bit about what these news releases mean. Let's see what else I have here. I'm going to show you what live audio and news squawk that I use that's totally free right now. A lot of these, they go free and they get a bunch of people in and then they charge later, but this one's still free, and I think it's pretty good. Talk about news release information, how news can be priced in. That's some of the ways I lost the most money when I started is I'd wait for a news release, the thing would come out, it would go the way I thought it would go, I'd get in my trade after, and then the trade would just totally reverse because, oh, everybody knew this was going to happen. They already priced it in, like the interest rate announcement, for example. So if you're really having trouble understanding that, we're going to talk about that more tomorrow morning. And I'm also going to talk about if the retail trader can have an edge, talk about patience, and how to set limit orders if I have time, so you can learn how to put limit orders in so you don't have to sit in front of your chart. So be sure to watch Andrew's talk coming in before myself. It's all in the live stream schedule. You can watch us in the previous stream, find us on YouTube, ask us questions in the message area. And Andrew and I are going to be chatting in just a few minutes live together, and we're going to try to put some little treats together for you at the end of this week. We're going to be coming on together, sort of talking to each other, just like we're talking to you one-on-one, sort of if we went out to the pub, had a meal, had a beer, whatever it might be, just talking about your trading, sort of really getting down to the stuff I think people really want to see. Because remember, I'm like you guys. I'm a trader. I trade as much as I can. The last week or two, I've been out in the markets more. I've done maybe 3 or 4 trades, but I'm really into this stuff, and I trade it all the time, and I want to know if I'm learning from somebody, what do I want to hear? I want to hear people putting their brain together, working with me, talking about my problems, getting me to get better with using my strengths. So we're going to be doing that in time to come. That's all I have for now. Thanks a lot. Happy trading.